A smooth moving average is a moving average that assigns a weight to the price data as the average is calculated, deals with a longer period, and represents the combination of a simple moving average and exponential moving average. A smooth moving average does not refer to a fixed period, but rather collects and enrolls all available data from the past. Let's talk about the smooth moving average period. This characteristic deals with the number of bars in the chart. In the case of daily data, the period will stand for days, whereas for months, it will denote months, and so on. The app sets a default of 9, but for the user's convenience, the period is lengthened, which allows you to view the data easier and create a general vision of the current price trend. Please take a minute and look at a whiteboard for a moment. Let's learn some more stuff.
Hello traders, this is Igor from FX Igor YouTube channel, and today we'll talk about Smooted moving average. First, let me see just the major facts about moving average. A simple moving average, SMA, calculates the average of selected range of prices, usually closing prices, by the number of periods in that range. As you can see, the formula is very simple. Price 1 plus price 2, we just go historically in the past and summarize prices and then divide with number of periods, the number n. But there is a little bit complicated formula for exponential moving average. I just created one simple equation just to see how exponential moving average look like. For you and for now, I will just give simple explanation. Exponential moving average just give more weight on a latest price data. It is some kind of weighted moving average. And today the main topic is a smoothed moving average, and we will talk about smoothed moving average. You see that the formula is quite simple, and that the first member of this equation is a simple moving average. And in the next, we calculated simple moving average, very simple, because smoothed moving average uses a longer period to determine the average, assigning weight to the price days as the average is calculated. So indicator takes all prices into account and uses a long look back per period. As we can see, all prices are never removed for the calculation, but they have only a minimal impact on the moving average due to the low assigned weight. By reducing the noise, removes fluctuations and plots the prevailing trend. So the SMMA, or smoothing moving average, can be used to confirm trends and define areas of support and resistance. It's often used in combination with other signals and analysis techniques. So as we can see, now we can go in a practical way to see smoothed moving average on the chart. Hello traders! Now we are in MT4 platform. Right now we're looking for Aussie dollar, and I just make purchase of this Aussie dollar currency pair, and last several days and weeks I'm long, but we are not because of that. We are here to talk about moving averages. So let me do that. I will go to the moving average and I will add smoothed moving average. For example, I will add 50. Now go there. Let me see this. Oh, like we see, smoothed moving average is very good as a support level right now in my case. But one question, what will happen if I put simple moving average 50 here right now? As we can see, it little bit different, and you can say just now, oh, the smoothed moving average is better. There is no such a thing better smoothed or simple moving average. It's just about period, because 50 smoothed moving average period 50 is maybe as same as I put 75 of simple. Look this. Closer. Look this. More closer. Look this. I will put 100. Almost match. So as you can see, smoothed moving average is a little bit like a simple moving average with a bigger period. The SMMA can be used to confirm trends and define areas of support and resistance, and it's often used in combination with other signals and analysis techniques. We know about the smoothed moving average that uses a longer period to determine the average, assigning a weight to the price days as the average is calculated. The indicator takes all price into account and uses a long look-back period. We know when we analyze this chart that the old prices are never removed from the calculation, but they have only a minimal impact on the moving average of the low assigned weight. By reducing the noise, removes fluctuations and plots the prevailing trend. So this is the answer why we have such a, when we make comparison with the moving average, simple moving average and smoothed moving average, we can see that SSMA can be used to confirm trends and define areas of support and resistance. A little bit different with a simple moving average, like we just need to change a period of time. So in my personal opinion, smoothed moving average and simple moving average are very similar, and the only difference is number of periods. So as you can see, simple moving average can be very similar to smoothed moving average if you put the smoothed moving average to be 50 and the simple moving average to be 100 period of the time. Of course, it's not the same, equation is not the same. I just want to tell you that exponential, simple, smoothed moving average, they're very similar, and you can choose anything that you like, you're comfortable to trade. There's no some rule, oh, exponential is always better than smoothed and so on and so on. But what is the practical explanation and practical advice for trading? First, the big dogs traders, they try to use moving average like 50 or like 100 or like 200 and so on and so on. As you can see, like we have 100. This is the simple moving average. For the smoothed, it's like this. And you can see that the simple moving average, exponential moving average, smoothed moving average, you can use various combinations. There is no some special rule there, because sometimes you can put the smoothed moving average and it can be perfect support for some chart, and next month maybe 50, 100 or 60 or something, some other moving average will be better than that, and next 2 years will be some other, because market's changing, fluctuates, the charts and charts patterns and shapes and everything is different every single month, and there's no rule that we can apply and tell just, oh, use this simple moving average and you will be successful in your trading. There's no such a rule. But however, there is some very important simple moving average that I just want to tell you, exponential or simple. It's 200. 200 moving average is very important price level, and a lot of big corporations, big dogs use that in analysis. Very often you can see on the Bloomberg that technical analysts, experts talk about that, and very often talk about simple moving average 200, and we just talk about the major up, down, or rising trend, and it's always the news when some currency pair or stock or commodity just broke some important level, like here you have in May when Aussie dollar has broken, like you see, 200 200 moving average, and since then it's above that. And since then, from the May of this year, Aussie dollar is a strong rising trend, and we can apply that in trading, use that in trading, and so on and so on. So the important fact we can use, for example, right now, put a moving average, put a simple moving average 200. We can put smoothed average 200. We have 3 different lines, but all 3 are strong support for Aussie dollar on daily chart. And usually you cannot miss, because 200 simple moving average, 200 exponential moving average, 200 smoothed moving average is always, they're very close. It's not some big difference, but I just want to tell that you can use that in trading as a thing, as a tool to determine the daily, the long-term trading trend. And when we have days and months above 200 moving average, we can tell that that asset, that stock, that currency pair is in the bullish trend. So this is it. Thank you and bye-bye.
Do not forget to subscribe.